In the world of finance, market volatility is a crucial concept for investors, traders, and analysts. One of the most common ways to measure this volatility is through the calculation of standard deviation. But what exactly does standard deviation tell us, and why is it significant? Imagine two stocks, Stock A and Stock B. Over the past year, Stock A's price fluctuated between $95 and $105, while Stock B swung wildly from $70 to $130. Although both stocks may have similar average prices, their risk profiles are very different. This is where standard deviation comes in. It quantifies how much the prices tend to deviate from their average value. The process of calculating standard deviation starts by finding the average, mean, price of the asset over a given period. Next, we calculate the difference between each data point and this mean, square these differences, and find their average. The square root of that average gives us the standard deviation. A high standard deviation indicates that asset prices are spread far from the mean, suggesting high volatility. Conversely, a low standard deviation means prices are close to the mean, signaling stability. In financial markets, assets with higher volatility are generally considered riskier, but they also present greater opportunities for profit or loss. Standard deviation is not just useful for individual assets. In portfolio management, investors use it to compare the risk levels of different investments, to balance portfolios, and to execute strategies such as diversification. For example, an investor may combine assets with low and high standard deviations to adjust the portfolio's overall risk level. Despite its usefulness, standard deviation has limitations. It assumes that price movements are distributed symmetrically, like a bell curve, which is not always the case. Extreme events, market crashes, or sudden spikes can distort results. Moreover, it looks strictly at past data and says nothing about what might happen in the future. Nevertheless, standard deviation remains a foundational tool in finance. It helps quantify uncertainty, aids decision-making, and provides a framework for comparing investments. Anyone seeking to understand how markets behave will benefit from mastering this central measure of volatility.